Kilol Pandya, Senior Fund Manager Debt at LIC Nomura Mutual Fund, now joins in on the show. Well, thanks very much for being with us, Kilol. To start off with, you do have quite a bit of activity which is brewing when it comes to the currency as a whole. Given that we are seeing a one-week high, do you think that this momentum is sustainable when it comes to the medium term?
It is possible that the momentum will be maintained at least in the immediate future. The medium term is of course not so clear, and it's basically part of the broader story wherein the current economic situation is fraught with uncertainty. There are a lot of improbables, a lot of moving parts to the equation. Whereas now, yeah, it has seen some appreciation. Immediately in the future, it may continue on this trend. Although I doubt if there will be any strong moves. But from a medium-term perspective, which is what the question was about, as we move beyond the current quarter and probably beyond the next quarter as well, I maintain serious reservations regarding whether we can, exponentially appreciate from here as well as even maintain these levels. So my medium-term view would not be so bullish on the rupee per se.
Kilol, India has garnered something like $22.7 billion via the forex swap window, and that will be closing on the 30th of this month. Do you think that once the swap window is closed, we might see a little bit of jitteriness creeping into the currency, or do you think that the RBI will, or rather should, extend the forex swap window?
It is of course desirable from a market participant perspective that RBI extends that window so that it adds to or it at least provides some certainty to the participants per se. However, I'm sure greater wisdom resides with the central bank, which takes into account the long-term ramifications of continuing with such swaps, which probably may lead to RBI not extending such a window. In which event, yes, some amount of jitteriness will naturally come in. As of now, I doubt if the market is expecting an extension. And nevertheless, once the windows do close down, it'll add that much uncertainty to an already uncertain scenario, and may lead to some additional pressure on the currency.
The other thing is what a couple of experts in the course of the last 2 weeks have told us, Kilol, that the bond markets and the way the yields have behaved, this is traditionally the levels from which the yields tend to correct. And they say that even fundamentally these are good prices to maybe go long on the 10-year. Is this something that you agree with, one? And two, over the course of the next couple of months, how do you expect the bond prices to behave?
The last couple of times I have been here, I have been maintaining that we ought to see a cash infusion into the system, and that probably in conjunction with successive repo hikes will lead to some amount of steepening. In some form or fashion that has come to pass. We are seeing an increase in the M3 per se, and that has led to a substantial downward pressure on the short-term yields with a pivot of about 2 to 3 years. However, as far as the longer corporate bond story is concerned, I don't remain so confident. Already we have seen some amount of uptick in terms of how the corporate bond yields have behaved or have moved. And if we do end up seeing a further tightening in terms of repo rates in the medium term, say 6 months down the line, then that story might exacerbate. So as a trading play, it probably might be a good time to get in. But as far as a buy and hold strategy is concerned, or a predominantly buy and hold strategy is concerned, I am not so confident that these levels are the correct levels to enter as far as long bonds are concerned.
How likely is that repo rate high? Because I look at the white papers and daily we speak about vegetable prices going through the roof. If it was onions a couple of months back or a month back, it was tomatoes yesterday and whatnot. I mean, I'm sure housewives are shuddering going to the markets right now. So the question really remains, does the RBI look at the CPI that seriously, because that doesn't seem to be cooling off, and probably take another rate hike decision in the month of December?
From the perspective of how the new governor is seeing inflation and the disaggregated numbers, there is an increased focus on the CPI and its components. The references being made to CPI, whether it is in terms of inflation index bonds or generally, the references from the central bank have definitely increased, which leads me to believe that more focus is existing now on the disaggregated components of the inflation parameters, be it WPI or CPI, than previously. Having said that, we have also seen the governor mention that the chances of a repo hike are relatively lower. To put all this in context, I believe that RBI's decision will pretty much depend on how the inflation numbers pan out as we go along. Even in December, we'll probably need to see how the inflation numbers are panning out. If there is a feeling that the inflation trend line is going to trend downwards and we will settle around 6-ish by the time we close the fiscal, then probably RBI's hand will not be forced to bring about repo hikes. However, in the event that inflation continues to be sticky, especially CPI, which on account of food pretty much is remaining about 10%, it remains in double digits, it is possible that RBI's hand will be forced, if not immediately, a little later down the line. I don't rule out one or in the worst case 2 repo hikes by the time we end H1 of calendar 2014. But then that is assuming a certain number of events panning out, especially on the inflation front. But I'm not ruling it out either. So to answer your question, whereas 18th December hike might not be so likely, I'm not ruling out future repo rate hikes either.
Kilol, just to get right back to the bond yields now, interestingly, the yields on the Chinese government bonds are at 9-year highs, and we've seen quite a bit of an uptick for our own bond yields. But just want to talk about what the reaction is going to be, given that we're not expecting a great set of GDP numbers. How do you see the bond yields trending?
The bond yields, let me give you a perspective on this. Per se, our macroeconomic scenario is not greatly heartening. The GDP numbers continue to trail. Nobody is factoring in a sharp recovery. Probably the recovery will be U-shaped in nature. In addition, we are seeing a slackness in domestic demand. As well as no great progress being made on the supply side. We are not really seeing too much happening regarding the bottlenecks on the supply side, as the governor had put it. The whole matter tends to get exacerbated because we are going into an election year. Apart from the political uncertainties which are associated with an election event, there is also an outside chance, or rather a good chance, that we may see some additional fiscal slippage on account of some SOPs which the government might wish to dole out as we go towards elections. Of course, these are moving parts. It's not necessary that all of them will pan out, but these are adding to the worries of market participants, which is in part the reason why the yields are trending upwards. Now, until these events come to pass and we gain greater clarity, I don't expect any sharp downward movement in the bond yields. As I mentioned before, the background is fraught with uncertainties. Volatility is here to stay. So in that context, it's difficult to find a reason to be bullish and build a book, as it were.
Yeah,
in that context,
Kilol, let me
I
just
remain
come in out here. Kilol, excuse me for coming. I have a small question. Yesterday one of our correspondents did a story about how there is a further 4% expenditure cut planned by the finance ministry. So they are definitely trying to plug that end, which could actually lead to fiscal slippages. Two, with what the Iran deal has done is the expectations at least thereof that crude will probably slip off over the course of the next 3 months. Don't you think these add to a slightly more positive outlook on the fisc picture as opposed to being a negative outlook?
I'm not saying that the outlook is negative. These are the worries. Like I mentioned, it's not necessary that all of these events may pan out. These are adding to the worries which are manifesting themselves in terms of how we are seeing the yields perform. Definitely the measures, or at least the intent which is announced yesterday regarding plugging the expenditure piece is heartening. But I think the market will wait to see how and to what extent these steps pan out before it jumps onto the bandwagon and starts taking bullish positions. The bond markets have seen decent amount of pain in the previous cycle, and it will take a little more than intent for the participants to start putting their money where the intent is.